I'm Mary Lyons, the Wealth Woman.
And I'm Eric Alexander with Benchmark Income Group.
Welcome to the Big Wealth Podcast.
So today we're going to talk about a really, really fun conversation, and it's about how long you're going to die or how long you're going to live before you die.
I hope I die quickly. I hope I'm not dying for a long time.
So we get this question a lot. Hey, we're making this money. We're getting ready to go into retirement. How much money am I going to have? And how long will this last me? Or how long do I need it to last me? And the question is, really around, am I going to be okay? That's what they're trying to figure out is like,
am I going to have enough money to take income no matter how long I live? That's what they're really asking.
Right. More money than birthdays, if we want to simple it down, right? And the question really revolves around this idea of, well, I don't know. How long are you going to live? I had a woman in my office, gosh, and this was a decade ago, probably 12 years ago. And she was in bad shape. And I'd met her during a networking group, and I didn't tell her this because I was trying to be pleasant, but she was in a hard spot with money, and it wasn't going well. But she was like 73 years old. And in my mind, I'm thinking, this is really bad because you're really healthy. And if my crystal ball sucks, but if I had a crystal ball, I'm thinking, man, you got another 10 years or more easily to go based on everything I know about you. And you don't have 10 years more of money. Like you're in a bad spot. So really centered around this idea of life expectancy versus life potential is really the two big questions that we always have to ask whenever we're talking about sort of longevity or how long my money needs to last. So Mary, talk a little bit about this idea of life potential, or not life potential, but life expectancy.
Yeah, well, I actually want to go back to something that you just said a minute ago, because you mentioned the word longevity. And when we think about risk in terms of income for retirement, the two biggest risks that you have are sequence of return. So if you get an adverse sequence of return, meaning you take losses early in retirement, that's number one. And then number two is longevity, is the other reason that people run out of money, right? So if the money needs to last for longer than you were planning, then you're in a world of hurt. And this is where sometimes I tend to get frustrated when I start looking at advisors who are doing Monte Carlo simulations and they're running these stochastic analysis of, how long should the money last, is that frequently they use life expectancy when they're doing the planning. So life expectancy is the idea that I can look at the entire US population, and I know that some people are going to die in childhood or in their teenage years, and then some are going to live all the way until age 117, I think is the oldest living person today, according to the Guinness Book of World Records. But when I look at that, most people don't live that long. And so when you start looking at life expectancy, the number is actually much, much lower. And if you contrast life expectancy with life potential, there could be decades more that you should be planning for than what someone might actually plan for.
Right. Yeah. And it's this big, giant binomial distribution, for the $10 word of the podcast. Or
we're killing it with stochastic analysis and binomial and all this business.
So yeah, but that idea that bell curve from high school that I was always relying on in order to pass every test was this idea that, some people are going to be at the edge, some people are going to be at the front edge or the back edge, and that hopefully you're in that middle cohort of people they're going to, die at 85 or 83 or 84, whatever that number looks like. But to your point, that idea of potential, what happens if I live to 90? What happens if I live to 95? If I've planned to die at 85, but I'm still kicking around at 90, I could have a problem. And everyone gives that joke. Oh, not me. When I'm running out of money, I'm going to spend the last 50 cents on a bullet and I'm done. And that never happens, right?
The lead plan. I find it so fascinating when people say that. So I just want to throw this out there. If you do a quick Google search for what is life expectancy in the US, the first thing that pops up is the numbers from 2019. And in 2019, The number was about 78.79 years. So call it 79 years old if we're using round numbers.
Right.
What's really interesting, though, is if you scroll a little bit further down on the Google machine, there's a report from the CDC, which actually it was released in August 31st of this year.
Oh,
And it says that life expectancy in the US is now 76.1 years.
that actually
And
dropped.
yes, and that decline occurred because of the experience that we had from COVID. And so I think that like why it happened, I guess, in the scheme of things is interesting in its own right. But I think if you're looking at life expectancy and you're thinking, okay, somewhere between call it 75 and 80 years old, you're looking at 15 years, right? If you retire at 65, and then we've got some Americans who are working till 70 just so they can collect a bigger Social Security check. And
Right.
so you're looking then at a 10-year time period, maybe on the outside, 5 to 10 years is what you're thinking if you're retiring at 70. And so when you have that mindset, you're like, okay, I should be good. I've got enough income to last me that long. But if you're healthy, I mean, I think about my grandmother. She lived to be 98 years old. And she was born during a time where we didn't have the same access to healthcare and all
Right.
of the benefits that we have today in terms of being able to change your diet and just even the information that we have and the ability to live better lives if we want to. And so if you look at the difference in planning to age 80 and planning to age 100, that those are totally different experiences. And I
Right.
think there was a report that came out from a group of insurers, and they were looking at mortality experience.
Right.
And they concluded that if you were in average health by American standards, so we're not talking about anything fancy, just average health, and you were married and age 65, that there was a 50-50 chance that one of you would still be alive at age 94. Well, that's really different than planning for age 76.
Right.
I mean, we're talking about 2 extra decades of income that needs to be there if there's a shot that one of you is still going to need income at that time period. And when you factor in that you tend to spend a lot of money early and then kind of decline to spending a smaller amount of money.
Right.
And then as you approach end of life, your medical expenses go up dramatically. So you have higher expenses again. You can't make a mistake in the wrong direction by looking
Right.
exclusively at expectancy.
Well, and then there's this other idea that says that the longer you live, the longer you will live.
Mm-hmm.
And it's this idea that says, well, if I've made it to 50, then something else didn't kill me off. I didn't die in a car accident when I first learned how to drive. I didn't have some sort of weird disease that knocked me out. I didn't do something dumb and jumped off a pier or something because somebody dared me to do it. Right. I
Right.
didn't do something dumb at the beginning that knocked me out. If I've
Mm-hmm.
made it this long, then I've got a good chance of going on. And if I make it to 60 or 65, the likelihood I'm going to make it much further goes up dramatically because I didn't
Right.
get killed off with cancer. I didn't get killed off with some other thing that happens in that next group. And they also said that a lot of life expectancy changes with income. Like if you're
Mm-hmm.
very affluent, you have a tendency to be a slightly longer lifespan than if you are, living on the streets. And so it's a lot of this idea of how long you're going to live is really a very personal number.
Mm-hmm.
And the better job you've done of taking care of yourself physically and financially, then the likelihood you're going to be around for a long time goes up pretty big.
So let's talk about that too, right? Because who better to deal with mortality experience than the life insurance companies? And when you look at about the time I got licensed and got into this business in 2003, most of the policies being issued by insurance companies had maturity dates of roughly age 100. So call it age 99 or age 100. And so if you think about what happens, and a lot of people don't realize this, but if you live to the maturity date of your permanent insurance contract and you haven't, I mean, you're alive, so you're still here on the
Right.
planet, they actually pay you the death benefit while you're alive. And the problem with that is that the tax treatment changes because typically a death benefit in a policy, if you leave it to your beneficiaries because you died, you graduated from the planet, and they write the
Right.
check, is income tax free. But if your insurance contract matures while you are still alive and they pay you the money, the growth is taxable at ordinary income tax rates.
Right.
And so if you think about the difference that that would make for your heirs, if you died at 99 and 364 days in that scenario, if you
Right.
had I'm going to make up numbers, a $10 million death benefit, they get all of that income tax free. But on your 100th birthday, if you get that check for $10 million, and let's say you'd put in $5 million to the contract, that $5 million worth of growth is taxable at ordinary income tax. So the amount of money, if you died the day after your birthday, that you would leave to your kids would be a dramatically different number than had you died the day before your birthday. And so when you start thinking
Don't
about
sleep too
that,
easy there, Grandpa. It may not look out so well.
yeah, I'm sure there were instances of that, right? But generally speaking, this is not something that an insurance agent would actually talk about with a client. And
Right.
so people are like, "Hey, wait a minute! I just lost out on $2 or $3 million that I was supposed to have." And so, do you think they might have decided to sue the insurance company? I didn't know this could
Maybe
happen.
just a little
This
bit.
Right. And so then if that goes to court and the insurance company loses and they're trying to make up, call it a $3 million after tax amount for that particular family,
Right.
they've got to pay them enough that after they pay taxes, $3 million is left over. And so let's say then the insurance company is writing a check for another $5 million.
Right.
Right. I'm making up math here, but if you think about that now, the insurance company has actually written a check for $15 million as opposed to the 10 that they had planned for based on the contract itself. And so if that happens enough times, the insurance companies start to make changes. And so I think it was in the aughts that they, as a whole across the country, pushed the mortality experience back. So they pushed the maturity date back to, in most cases, 120 years. And so if the insurance companies feel the need to do that because people are living beyond 100, that's definitely something that from a planning perspective, we need to take into account as a possibility.
Right.
There's a
Yeah.
difference between probability and possibility, but you have to plan for the possibilities because if you think about it, our job is to make sure the plan works no matter what happens. That's the whole reason you have a plan, because otherwise you could just call it hope.
Right. Yeah. Well, and I think that's it. I mean, not to land the plane there, but I think that's the brilliance of kind of the importance of having a plan that goes for the full 100 years or the full 115 years or 121 years, is that if you've planned for that life potential and you are the average and you died at 80 or 81 or whatever that is for you, then great, right? You just left more money and everybody's fine with that. But if you don't, and you're still kicking around at 115 and you still need income, you don't want to be a burden on someone else either.
Mhm.
Right. Because to your point, you have the go years, the slow go years, and the no go years. But in the no go years, the no going usually gets replaced by medical expenses. And
Right.
so nobody wants to write those checks if they don't have to. And so really thinking through that idea of longevity and making sure you have more money than birthdays. And the cool thing is for me is that it's a really simple problem to solve. You just have to know the levers and knobs to pull.
Well, and to that end, that means incorporating actuarial science into a financial plan.
Exactly.
Right? If the people who are really, really good at dealing with mortality are the insurance companies, why would you not incorporate some element of actuarial science and the ability to deal with unexpected life potential or unexpected expectancy? That's where I was going. And I realized that just isn't going to work. But why not incorporate some element of that into a plan so that you don't end up running out of money? And it's not that hard to do. And in some cases, pooling mortality experience can actually mean that you can increase what you get to spend without fear of ever running out over the duration of your lifetime, no matter how long you live. And there are very simple tools you can use to accomplish that. And if you get to make sure that you don't run out of money and potentially increase what you get to spend each year, there's not a whole lot of downside. And that's definitely something to ask an advisor about.
Absolutely. Where can they find you, Mary?
They can find me at The Wealth Woman wherever you social media.
And so if I don't botch this, and I'm on Economics with Eric on Facebook and LinkedIn, and just Eric Alexander on LinkedIn.
You're
as
getting
well.
pretty good at this.
I'm getting better at it. You guys have a
See you
great
next
day.
time.
you.